When we think of debt, we often associate it with financial trouble. However, the rich have mastered the art of using debt to their advantage, turning it into a tool for wealth creation. How do they do it? This is the story of how rich people make money with debt, using strategies that can transform liabilities into assets. Leveraging real estate investments. Real estate is one of the most common ways wealthy individuals use debt to build wealth. By taking out mortgages to buy properties, they can leverage their investments to purchase assets that appreciate over time. The key is to buy properties that generate rental income, which can cover the mortgage payments and provide additional cash flow. For example, a wealthy investor might purchase a multi-family apartment building using a mortgage. The rental income from tenants not only covers the mortgage payments, but also generates a profit. As the property value increases over time, the investor's equity grows, creating significant wealth. Rich investors often use this strategy to diversify their portfolios and build a steady stream of passive income. By leveraging debt, they can control large assets with relatively little of their own money, maximizing their return on investment. Using margin loans for stock investments. Wealthy individuals often use margin loans to invest in the stock market. A margin loan allows them to borrow money from a brokerage to purchase stocks, using their existing portfolio as collateral. This enables them to buy more shares than they could with their own capital alone, amplifying their potential returns. For instance, if an investor believes a particular stock is going to rise, they might use a margin loan to buy more shares. If the stock increases in value, the gains are multiplied because the investor controls more shares. However, this strategy also comes with higher risk, as losses can be magnified if the stock price falls. Using margin loans requires careful risk management and a deep understanding of the market. Wealthy investors often work with financial advisors to develop strategies that balance potential rewards with the associated risks. Starting or expanding businesses with leveraged buyouts, LBOs, are a strategy used by wealthy individuals and private equity firms to acquire companies using a significant amount of borrowed money. The assets of the company being acquired often serve as collateral for the loans. This allows the buyer to control a company with a relatively small amount of their own capital. The goal of an LBO is to improve the company's profitability and sell it at a higher price. For example, a private equity firm might buy a struggling company, restructure it, improve its operations, and then sell it for a profit. The use of debt amplifies the returns on the equity invested by the buyers. This strategy is popular among wealthy investors because it allows them to control large companies and potentially realize significant gains with limited upfront investment. However, it also involves substantial risk and requires expertise in business management and restructuring. Tax advantages through interest deductions. Wealthy individuals often use debt strategically to take advantage of tax deductions. In many countries, the interest paid on certain types of loans, such as mortgages and business loans, is tax deductible. This reduces the overall cost of borrowing and can lower their taxable income. For example, if a wealthy individual takes out a mortgage on a rental property, the interest payments on that mortgage can often be deducted from their rental income, reducing their overall tax liability. Similarly, business owners can deduct interest on loans used to finance their business operations. By strategically using debt and taking advantage of interest deductions, wealthy individuals can reduce their tax burden and improve their cash flow, freeing up more money for investment and wealth-building activities. Creating wealth through arbitrage. Arbitrage involves taking advantage of differences in interest rates to earn a profit. Wealthy individuals can borrow money at a low interest rate and invest it in assets that generate a higher return. The difference between the borrowing cost and the investment return is the profit. For example, an investor might take out a low-interest loan to invest in dividend-paying stocks, bonds, or other income-generating assets. If the return on these investments exceeds the interest rate on the loan, the investor makes a profit. This strategy relies on careful selection of investments and effective risk management. Arbitrage can be a powerful tool for building wealth, but it requires a deep understanding of financial markets and the ability to identify profitable opportunities. Wealthy investors often use this strategy as part of a diversified investment approach to maximize their returns. In conclusion, the rich use debt not as a burden, but as a tool to create wealth. By leveraging real estate investments, using margin loans, employing leveraged buyouts, taking advantage of tax deductions, and practicing arbitrage, they turn liabilities into opportunities. These strategies require knowledge, planning, and careful risk management, but they demonstrate how debt can be used to build significant wealth. Thank you for watching. And if you liked this one, subscribe to Luxe Lane and check out some of our other videos.